My name is Adam Myers. Thank you for dialing into today's webinar update. Today, we are joined by Ted Franks, the Portfolio Manager of the Pengana WHEB Sustainable Impact Fund, and Seb Bilo, who is the Head of Research. Ted will provide a performance update with a focus on the environment for our style of investing and the resulting impact on our performance. He will then hand over to Seb, who will walk us through the key highlights of this year's impact report. As always, if you have any questions during the presentation, please enter them into the Q&A box, which can be accessed from the icon on your screen. And we'll aim to cover as many of the questions as possible at the end. And with that, I'll hand over to Ted to get us underway.
So this update on the Pengana WHEB Sustainable Impact Fund, we've got Q2 2025 in the title. Actually, we're going to give you a full year kind of view over the last 12 months. I think we last spoke to you on a webinar last autumn. And actually, the full year is quite a useful period to talk about, as I'll come on to explain, because it kind of is bookended by the point at which it seemed as though Donald Trump looked like he was likely to win a second term in the US. And as you guys will know, the US is a big part of, it's a majority of the investment fund. It's a big part of global capital markets. And what we're about to talk about, a lot of it, although it has global implications, is what's been going on in the US has really been the big factor. The format of what I'm going to say is the update of the year with the sustainability lens on how that's impacted our strategy, and then we'll come on to the outlook. And as a sort of heads up to start off with, obviously it's been a tricky year as a headline, but actually we think now is a really interesting time to be invested because there's a lot which can definitely go better from here and probably will. So with that as an intro, let's get on to the context. So after Trump's election in November and then his inauguration in January, we really have been looking at a pretty unusual period. This strategy's been going for 20 years. We've never really seen, obviously, political support for sustainability has wavered, but we've never really seen it be quite so much in the crosshairs as it currently is now. The next couple of slides are just a few examples of things which are really at the extreme end of what you can do if your agenda is kind of deliberately to have a go at sustainability and the green transition. So on this slide, we've got on the left-hand side a memo by a man called Doug Burgum, who is the US Secretary of the Interior, specifically calling out and trying to stop a very important or sort of landmark offshore wind project called the Empire Wind project in New York. That project was fully permitted and permissioned, and so it's extraordinary for the government to intervene so directly. And in fact, they did row back on that fairly soon after, but it was an incredible intervention anyway, and just shows the level of animus towards renewable energy. The chap in the middle is a guy called Peter Marks. He is a senior person at the US FDA. In fact, as you can see on the letter he wrote on the right, he's the director for the Center of Biologics Evaluation Research. The point about that is he was at the top of the tree, which included the vaccines team, and was a big person in part of the COVID efforts, and really quite an admirable person in terms of what he'd achieved. He was unceremoniously ousted from that position by the new Health and Human Services Secretary, Robert F. Kennedy Jr., who's a well-known vaccine skeptic. That happened in March. What we've seen since is a sort of continuation of this theme, very sort of anti-science, very sort of populist approach. And that's been extremely difficult for a lot of our sectors, particularly obviously health directly in this case, but this sense that there's a pushback against kind of thoughtful science around trying to make the world more sustainable. Next slide's got more examples of the same. So PFAS, forever chemicals, they are tiny chemical particles for substances created for specific purposes to be very hard wearing. They're now in our environment, not great for us. The direction of travel absolutely is to think about that and regulate those. Trump administration interested in somehow making that softer. That's a very contrarian stance. Similarly in the middle, ethylene oxide. This is a substance which actually has a much more useful, or has a very clear useful purpose in sterilization of hospital equipment. But again, the general thought is that this needs to be regulated more carefully rather than softened, and the Trump administration is looking at softening the regulations. On the right-hand side, one of the news stories this year, attacking the charitable status of environmental groups, which is a really kind of specific and kind of pernicious way of destabilizing a lot of what people are trying to do in sustainability. So absolutely, sustainability in the crosshairs as a result of this administration at the moment, as they go through with their sort of early legislative agenda. Now, a big part of that agenda outside sustainability is also something of a challenge for investors like us who invest on a global basis. All of our companies, with some small exceptions, tend to have a global outlook. They will sell their products in differing amounts, but broadly between the Americas, EMEA, and Asia Pacific. On top of that, they have sophisticated supply chains. They tend to be kind of intellectual property led. It'll be a piece of technology which solves a sustainability challenge. So, as you all will have seen, a key legislative target for Trump is rebalancing global trade to more to his taste and the taste of his followers. 2nd of April is Liberation Day. You can see on the right, that was his announcement of what the potential tariffs would be on global trading partners. That's him holding up the card there. The right-hand side, how the proposed effective tariff rates compare to history. So pretty dramatic. And of course, we're right in the crux of that now because the self-imposed deadline is the start of August. And we're now getting to the point where we're finding out what we think those new terms of trade should be. Again, pretty challenging if you're trying to invest in a globalized sustainability strategy. Lastly, again, dominating the headlines, the one big beautiful bill, the way that the US is so polarized now. In order to get a lot of the domestic agenda through, you have to do it through a budget bill, so-called reconciliation bill. If you go back through the last few presidents, Biden had the Inflation Reduction Act, the IRA, that was his signature thing, that was a budget bill. Before that, Trump had the Tax Cuts and Jobs Act, and before that, Obama had Affordable Care Act, which was Obamacare. So these big, important cyclical bills come through kind of broadly once in every administration. And what Trump has gone for in this bill, which was signed into action just after the end of the quarter, was really is embedding those tax cuts which he introduced in his first term, but also funding that and funding what he wanted for defence and borders by pulling back on a lot of the safety net stuff for the poorest people in American society, including food benefits, but also, again, having a very clear attack on the green energy complex, dismantling the Inflation Reduction Act, and then looking at Medicaid, which is provision of healthcare for the poorest people. Now, in 2017, when the Tax Cuts and Jobs Act came in as a smaller sort of medium cap strategy, we benefited from those tax cuts coming in on corporations as well. Obviously, as growth investors, there's something positive there. The rest of this and its impact on US deficits is more challenging. And then the last sort of point to make about how all these things fit together, which is important to understand for our strategy, is around some of the economically sensitive things we do, which would be broadly in the environmental themes, resource efficiency, sustainable transport. We are investing in companies that invest or produce capital equipment which other companies invest in, and so we are sensitive really to kind of manufacturing investment cycles. One measure of that is the purchasing managers indices. You can see here that after a peak in the end of COVID, we've had this long, slow period, and particularly the fact that it hasn't recovered. This is now, by some accounts, you're looking back, you have to go back quite a long way to have this level of low industrial confidence in Western markets. So we really are in something of an industrial recession. Now, interestingly, the curve is positive, and we definitely saw signs of that confidence perhaps starting to increase at the start of the year. As the tariffs situations roll through, it's been a bit more muted, but we still think probably the direction of travel from there is upwards. It's just been suppressed by a lot of this policy change. So there'll be a chance for questions later on. Obviously, there's a lot of things going on in this very busy period, but those are the headlines I wanted to give to you. Do rest assured, when we get to the outlook section, we'll talk about why actually from here things are much easier to get more constructive about. So in terms of what that's meant for the strategy, well, we've been using this chart as an indicative kind of signpost for a little while now. We've pulled out some relevant indices and how we compare to them. The light green is the MSCI World, which is the global equity standard, something which we want to compare ourselves to and want people to think of us in terms of. Above that, you've had actually a strong period for mid-cap growth, which would typically be a style that we would expect to be exposed to. In this period, that strength has been quite localized to technology companies and also US domestics. So those are things which we have some exposure to, but not an awful lot. Bigger and more sort of indicative trends are provided by the grey and the black lines, so clean energy and the accompanying resource efficiency and environmental themes that we invest in. as highlighted by the grey line. And then particularly of interest in this period and in fact the last few years has been healthcare, the dark line there. And if you look at the shape of those lines, they've been very, very much influenced by US policy. Obviously, the clean energy weakening into all through Trump's sort of election, and then actually, fun enough, expectations helping that rise a little bit. But healthcare in particular, Trump administration being much worse than people anticipated on that front. Obviously, we are long-term investors, been doing this for a long time, and we very much welcome your support. This is the long-term strategy performance picture, and we're aware that that's really not a good one, and we're doing everything we can to address that, certainly since that period, since 2020, where sustainability support's really been weakening. But we think the future from here is starting to look much more interesting. So, a bit more detail on the actual fund performance, starting with thematic contribution. Some positives from the resource efficiency and sustainable transport, again, as some of those PMIs have started to pick up a little bit. But down at the bottom there, big negatives from cleaner energy and the healthcare themes. And you can see that writ large in the individual stocks here. So First Solar and Vestas, two of our cleaner energy stocks, are down in the negative contributors. And then the rest of that group is broadly taken up with healthcare names, as so many of those stocks have been challenged. Getting straight into that then, a key part of that challenge has been in our drug discovery companies. You can see the logos in the top right: Icon, Thermo Fisher, Danaher and Agilent. The last three of those are life sciences tools companies. Icon's a contract research organisation. We also do have Lonza, which reported today, which is a contract drug manufacturing organisation. So, biotech funding on the left-hand side, it's not all these companies do by any means. They do diagnostics as well. Also, what they do in biotech, a lot of it is consumables and recurring revenue, and they have applied and environmental applications for their products as well. But certainly, it is remaining at a relatively low level. And critically, some of the changes in the US sort of scientific complex, which I mentioned before, have cast a sort of chill on confidence to invest in new remedies. And on top of that, there is competition coming from China. So the sentiment against this sector is really, really quite bad. We would argue that you see on the right-hand side, this is the revenue of our contract research organisation, Icon, set against the total drug pipeline. And actually, you see those in the long-term trend, those numbers are still very positive. As we speak to you today, at the start of Q2 25 reporting, this is when a lot of these companies are reporting, and we're already seeing yesterday and today the reports being better than people expected, and the resilience of these companies being better than people expected. But the sentiment against this sector is very strong at the moment. As I say, we think that certainly with the advent of AI, but also with all the new different scientific methods such as cell and gene therapy, you're looking at a continuing drive for new drug expansion. But this has been weak, certainly this year. It's been a real challenge for us, and it's a big part of the strategy. It's not isolated though, and that healthcare black line includes more than just drug discovery companies, all of which have been struggling, most of which have been struggling for various reasons. Another example from our healthcare space is Gerresheimer. So we're interested in Gerresheimer for the products on the right-hand side. It is a maker of capsules and injectors and other products which use effectively plastic to deliver drugs. And because of the way the new generations of drugs are derived from actions of the human body or replicate actions of the human body, they're biological drugs, they have larger molecules, they're more sensitive, they need to be cared for more carefully. And so this is a company allied to that long-term trend. It has a number of large contracts coming through, which are starting just now. We started our position in Gerresheimer last year in anticipation of that change coming through. Unfortunately, on the left-hand side, Gerresheimer does have an existing legacy business in packaging glass, which includes for medical purposes, but also somewhat from cosmetics. And you can see the light green line there as the organic growth has been challenged for Gerresheimer. It's now extraordinarily derated, and we think there's a real opportunity from here, but it's been tough for us in the last year. On the positive side, Autodesk has done very well. This is a computer-aided design company. There's quite a lot going on here too. On the left-hand side, their transition from a permanent licenses model to a subscription, annual subscription basis obviously changed the way they reported. You can see that billings drop at the same time as revenue is staying the same. That sort of clouded the picture for the stock. What matters for Autodesk, as well as the fact they have an activist investor on board, which is sort of helping the management's focus on growth, but really they are very well placed for the application of like advanced digital technology to design in buildings and industrial contexts, which is the two kind of key areas they play in. They've been using digital twins, for example, for a long time, or creating digital twins. That's where you create a digital replica of a real world asset, and then you can test that in a digital environment. What artificial intelligence and machine learning can do in terms of enhancing the reality of the virtual reality, effectively, of that product is really quite striking. And this is creating a new kind of double-digit organic growth path for already quite large companies. So we're very interested and pleased about this, and it's one of the areas, we should say, where we're starting to see AI applications come through. All of our companies are very keen on using AI to solve sustainability challenges, and this is a good example of that. The last positive company performance just to talk to you about is Train Technologies, which is a heating, ventilation and air conditioning company. Clearly, as part of climate adaptation, that's a very strong demand strand they're feeding into. You can see those numbers on the left-hand side. Those are big percentage growth rates they've been putting up. They're very, very well run and efficient. They capture a lot of that growth. They are also exposed to data center cooling, which helps, gives them the extra kind of juice on that organic growth number. We like them from an impact point of view. They are very focused on their carbon footprint, which is as important, more important now than ever, really, given they are what they do is becoming a bigger part of the economy, and the growth is there. The chart on the right hand side just tracks a little bit just how far we really have come in terms of the refrigerants used for a lot of this cooling, and actually, you know, that those are relative. You've got the ozone depletion and the global warming potential on the same chart, though. Those relatives are really quite striking. So this is a good story from both a impact and an investment point of view. Okay, so I feel a bit like I've been rattling on, so I'll keep going. We'll get questions at the end. But now I think it's important to really talk about why we're so positive at this point, having had really, as I say, probably the toughest year from a sort of backdrop context that the strategy's had in its existence. This is the first and the biggest, and if there's one chart you take away from us, it's this one. So the perception that investing in sustainability is now a finished project is pretty large in equity markets at the moment. These are the relative valuations of our portfolio. You take the price to book on the left hand side, the price to earnings on the right hand side. You take that, turn that into a percentage of the local markets, and then you rebase it to 100 over 10 years. Now, clearly, at the peak of sustainability over-enthusiasm in 2020, there was that high point where all the stocks are sort of run up relative, and this was going to be the level of change which we think the world needed to really make the green transition. Since then, the retreat has been even more marked, and we're now down, certainly in price-to-book levels, plumbing new sort of lows, and price-to-earnings definitely back to where we came from. You can see this very easily when you look at the stocks individually across the portfolio. A decent number of them are trading around 10-year lows. We obviously think this is overdone, and if you're interested in sentiment and sort of momentum tailwinds, then we think this is probably a good place to start with sustainability. But the fundamentals also are interesting and have quite a lot of positives to them, as well as just the market sentiment changing. So stepping through those, first of all, you know, there is no question that since about 2016, when Xi Jinping unveiled the Made in China 2025 program, that China has been a significant part of addressing the global transition, which is great from a carbon point of view, but a challenge for Western companies because it's set out explicitly to try and invade some of the high-tech industries in which Western companies with their higher governance standards were trying to invest in. That has resulted in the sort of tariff mess we're currently in at the moment, but there's a couple of silver linings about it. The first is, if you look at the left-hand side, the idea now that we live in a world where governments think more carefully about industrial policy and trying to foster these industries to the future is probably a positive for our strategy. You can see that pie chart. You know, strategic competitiveness and geopolitical concerns are obviously key reasons why governments intervene, but also climate change mitigation is a big reason too. And actually, over the longer term, it's probably supportive to have governments thinking more sensibly about these changes. And the right-hand side just highlights just how much support China really has given to some of these industries. And to some sense, our point is that if there's a rebalancing to a more sensible way that we think about how we protect in the Western world, particularly the intellectual property of our companies, that is supportive for this strategy and should also make for a more orderly and sensible transition, which would be more popular amongst populations around the world. And that's obviously really key, because the expense of the supposed expense of the transition has been what's created a lot of this sort of backlash against it. To which point, the other, and I guess I can't really stress this one enough, this is another huge reason to be positive now. All through most of this 20 years we've run the strategy, the story has always been that this is too expensive to do and that electorates won't stand for it. The reality now, in large part because of that Chinese intervention or that Chinese approach, is that actually the boot is on the other foot, and a lot of these technologies are just the cheapest way forward. So we've got this great case study happening at the moment in Texas, where since the storms of the 2021 winter, there's been a deliberate approach to try and expand power generation capacity in Texas. That has taken the form of solar and battery. You can see those light blue bars each year, and then the grey bar at the top is battery. And that resulted in not just cheaper electricity for Texas, but also more reliable. It's got a very favourable setup for installing renewable energy, both from a market point of view and from a natural resources point of view. On the right-hand side, you've got examples of Republican bills produced by the Texas Senate, which were absolutely specifically designed to put renewable energy in the crosshairs and make it as difficult as possible in very irrational ways for developers to develop renewable energy. And we just think this is the cutting edge of the example where there is now, on a level playing field, there's now no question renewables is the cheapest way to go. And actually, the fossil fuel industry is very much on the back foot. And I think when you get to this point, you get to a point where fairly soon those floodgates open even more than they currently have, and we start to make real progress because the economics is so compelling. And as the economics is compelling, that coincides, interestingly, with this growth in power demand. This potentially could be very worrying if we hadn't got to the point where the renewable technology was so cheap, but it is very cheap. If you look at the left-hand side, after decades of efficiency reducing the power demand, which is great from an environmental point of view, we now have this thing where the growth in AI data centers, such as on the right-hand side here, you look at the US examples of data center power load projections, we're getting this new demand for power coming from artificial intelligence, and that group is clearly very commercially focused. If renewable energy is the cheap way to go, they will just do renewable energy. So we think it's really quite exciting. And then returning to the healthcare complex, which again has been so challenged recently, underneath the noise of the geopolitical tensions and the tariffs, and then also making political headway out of using healthcare costs as a target to shoot at. Again, reiterating the point we made earlier, the underlying drug discovery process and just the sheer quantity of people looking at really interesting new technologies doesn't stop. On the left-hand side, you've got large pharma R&D expenditure there. You can see continue to be very strong. And moreover, the way that works now is much more sophisticated. We invest in a company called AstraZeneca, a UK company, and its supply chain is really globalized. So actually, the opportunities for servicing that market in different markets where new breakthroughs can be happening, particularly obviously in Asia, but actually the same can be said for bits of the US, is really greater than it's ever been. So again, we remain very positive on the widening opportunity for companies that we invest in that service drug discovery. Last slide for me, again, just to reference artificial intelligence, quite a nice place to end. This presentation isn't around it just now. We have talked about it in the past. We're just at the point where all those artificial intelligence applications are getting to the point where the agents are really very useful in a number of activities, either client-facing or internally for all of our companies. This is using the example of pharmaceutical companies, $10 billion of deals announced last year in terms of the use of AI. That not only reduces costs, but also increases productivity, increases the opportunity set too. And that's something that, which again, we're very much tapped into. So we do think, with sentiment very low and with so many of the fundamentals aligned, that this is now time to be really more constructive on the strategy. But with that, I will pass over to Seb, who's going to talk about the 2024 Impact Report. Thank you, Seb.
So I am going to talk about our Impact Report, which we published a couple of weeks ago. It's actually our 11th Impact Report. So we've been doing this for more than a decade now, and I just wanted to start with reminding you, re-establishing probably for many of you, what our objectives are with the strategy, and that is to achieve capital growth by investing in companies that deliver a positive impact. We go into some detail around what those companies look like, the areas of positive impact that we're interested in. These are our 9 themes that many of you will recognize, the 5 environmental themes which support that objective to support a stable climate and healthy ecosystems. and then for social objectives as well, that support our objective to enable productive and healthy lives. And we have another focus on positive impact technologies that relate to those objectives. So that's the kind of the core purpose, if you like, of the strategy. The report really tells the story of 2024 in terms of the experience of investing in the fund. And as Ted has already emphasized, it was a tough year. Just hitting this point again around artificial intelligence infrastructure, which is something that we saw a big focus on in 2024. You can see here that at one point in 2024, NVIDIA, the maker of much of the infrastructure that's going in to support AI, had a market cap that was larger than 5 of the G7 stock markets. So just extraordinary growth in that one business. But as we've alluded to many times, AI is, and Ted has just mentioned, AI is very interesting for us in terms of the applications that are used to deliver a positive impact. But companies like NVIDIA and Microsoft and Meta and others, these large hyperscalers, provide this undifferentiated AI infrastructure, which isn't sufficiently focused on positive impact for it to be investable for us. So it's not an area that we invest in directly. And it also comes with a very hefty and rapidly growing carbon footprint. So on the right-hand side, you've got the data for Microsoft, their Scope 1 and 2 emissions over the last 5 years. And actually, you can see that this is compounding pretty rapidly. It's a compound annual growth rate of 18% over this 5-year period, which means that their emissions are have doubled actually since 2020, and similar story for the other hyperscalers as well. So as you may already know, AI comes with a very significant carbon price, and while some of that is being delivered by renewable energy, not all of it is, and that's what's driving these emissions profiles. And at the same time, we have seen the underlying sustainability challenges continuing to intensify. So this is a series of charts from the Stockholm Environment Institute, and they depict 9 critical global processes that regulate the stability and resilience of the planet's environment. They did an analysis first in 2009, you see that on the left-hand side, where they looked at 7 of these 9 global systems and concluded that 3 of those were already had already breached critical planetary thresholds. That's shown by that dotted line in the middle. And then when they redid the analysis in 2023, they looked at all 9 of those boundaries and considered that 6 of them were now in breach of those planetary boundaries. And in essence, really, this is confirming that human activity is degrading these systems and undermining their ability to provide a stable environment for human society. Obviously, this is most apparent with climate change, but we're also increasingly seeing evidence in areas like biodiversity, and now in the ubiquitous presence of novel entities like PFAS, the so-called forever chemicals, and the very significant negative impact that they have on human and ecological health. So all in all, pretty bleak year, really. So how did we adapt to those pressures? Well, the first thing that I wanted to talk about, and there are many areas that we cover in the report, but this is just one area that we focused on, and is a sort of notable feature, is the gradual shift away from the more volatile and higher impact parts of the investment universe and towards steadier areas of the market, which are still impactful, but less exposed to the intense negative sentiment that we've seen around the net zero carbon transition. And this is very much the result of sort of a bottom-up stock picking process that is visible at portfolio level. And the one that I wanted to call out is the shift into water management, where you can see in that blue line in the middle of the chart there. This started in 2023 when we added Veralto to our existing holdings in Ecolab and Xylem in our water management theme. And then in 2024, we also added American Waterworks, which is a US water utility. And then indeed in this, earlier in 2025, right at the start of 2025, we added Kurita, which is a Japanese manufacturer of water treatment equipment and services. And that's taken our exposure to water from around under 8% to over 14% over that period, which may not sound like much, but 6% is quite a big move for us. And in fact, we've never been above 10% in water management before. So it's quite a shift. And then the other one that I wanted to call out is on the safety theme as well. We didn't actually add any new holdings to safety, but added to our positions in these three companies, MSA Safety, Bureau Veritas, and Steris. And that took our weighting in the safety theme from around 7% to nearly 11% over the year. So a quarter of our strategy in total in these still positive impact areas, but as I say, less exposed to the very sort of stressed area around net zero carbon. We also, as I say, they remain very focused on positive impact, of course. These are our key performance indicators that we report every year on the impact associated with the strategy. You can access them also via the impact calculator on the website. And you can see improved impact in several categories, including in carbon avoided emissions there on the left-hand side, and renewable energy. And these increases are really delivered by improvements in the underlying technologies, where businesses are able to deliver the technologies at a better or equivalent prices, and that's led to more positive impact per unit of investment. And you see those changes in the charts there. The other areas of change that you see in year-on-year performance are really more the result of changes in weightings to those themes. So, for example, the wastewater treated increase is really due to the increase in weight that we have in that theme that I explained a second ago. And equally, we have lower weightings now in environmental services, which is linked with the waste recycled metric, and also in healthier lives. That's in our well-being theme. Those have less investment in them, and that's driven this reduction in positive impact. Still positive impact, but just lower than it was in the last couple of years. And we see this positive impact and indeed wider ESG performance as indicators of quality, of the fundamental quality of the businesses that we invest in, and that we think will provide a robust foundation for strong future performance, both on impact and also financial performance. And just to give you some additional detail about the sort of quality ESG characteristics that we see, this is a chart that we've produced every year for the last 6 or 7 years. It's data that is provided to us by a third party, so it's not data that we use as an input to our investment process. We're just taking a snapshot of the portfolio and how it performs against these criteria as an output. And there are 15 different criteria, sustainability criteria shown on this chart. And as you get closer to the outside of the chart, that shows improved performance. And you can see the dotted line is the MSCI World in the middle there. And you can see that we outperform the MSCI World on 13 of these 15 criteria. So very strong performance on ESG. Just a couple ones to call out. You can see how on gender equality we've improved performance year on year. And I have a chart in a second that shows you this in a slightly different view. Very strong performance on executive pay. That tends to be driven by our focus on more mid-sized businesses. And also very strong performance in terms of social and environmental good, which is the positive impact that you're expecting from the strategy. So you'd expect to see strong performance there. And indeed, that's what we deliver. So strong performance really across the board. This is the chart that I just mentioned on gender diversity. We've been measuring this for many years, and you can see over the 10 years or so that we report here, sustained and significant improvement in performance from around 16% back in 2016. This is the percentage of board and top management positions held by women, and now just over 30%, and critically ahead of the MSCI World now as well, as you saw in that other chart too. So really pleasing to see this performance. Obviously, we need to see further improvements, but good to see that that's been happening over the last few years. And then in carbon as well, continued progress here too. On the left-hand side, this is showing the proportion of the emissions from the portfolio that don't have a net zero, that aren't covered by a net zero carbon commitment. Our target is that 85% of the portfolio's emissions should be covered by a net zero carbon target by 2025. Actually, we have just exceeded that target. This year, we have 88% of the portfolio's emissions covered by a net zero carbon target as of the end of 2024. And then in terms of actual emissions, you can see we've more than delivered in terms of financed emissions. Most of this was delivered when we sold a Chinese waste to energy business back in 2020, but we've also seen continued reductions since then. In many ways, this yellow line is more interesting. That is showing you the ongoing reductions from companies held in the portfolio across the period. So it eliminates the impact of buys and sells. And the story behind this line is the initial reductions, which were very pleasing, but really were a result of COVID. We then had emissions bounce back after COVID, but since then, for the last couple of years, we have seen year-on-year reductions in Scope 1 and Scope 2 emissions from the portfolio. Not as much as we need to see, and we're some distance now from where we need to be. Nonetheless, it's, I think, reassuring at least to see that we are back on a downward trajectory here. We just need to accelerate. So those are some of the ESG quality characteristics of the portfolio, and that is replicated on the financial side as well. So we obviously look at quality across all the dimensions of quality, ESG and financial. And you can see here across these 5 metrics, just to emphasize this point, that the portfolio does have high quality financial characteristics as well, both in terms of margins, returns, and the fact that they're less leveraged. Our portfolio as a whole is less leveraged than the wider market. So just to sort of bring this to a close in terms of how we conclude the report. So I hope it's clear that we continue to focus on quality in the portfolio, which includes performance across ESG and financial dimensions, and that we see this as really reinforcing the strong foundation that we have, that we think positions us very well for a return to growth. Fundamentally, these are high quality businesses that we're invested in, that are well placed in our view to deliver strong financial performance. And it is worth saying that we have been here before. The WHEB strategy can trace its track record back to 2005. And for the majority of that period, we have seen strong support for these positive impact kinds of businesses. But over that 20 years, we have seen many cycles, and positive impact businesses have been in and then have fallen out of favor several times across that period. And the current lull in performance that Ted has been talking about, in our view, bears all the hallmarks of another cycle. And in fact, as Ted has said, we believe that prospects are much better this time because returns are driven not so much by policy, but by the underlying economics. And there have been multiple surveys of businesses that have confirmed that a majority do remain committed to focusing on decarbonisation, even if they don't talk about it as much, with many claiming that the sustainability initiatives are actually generating strong financial returns for them. And in the meantime, of course, the performance and competitiveness of the underlying technologies continues to improve. They have followed the Gartner hype cycle that you may well be familiar with, where the market gets kind of overexcited about a technology, and then you have this trough of disillusionment, it's called, as reality kicks in, that actually it's going to take longer for these technologies to be deployed, and then you have this gentle return as the markets mature, and we've seen solar PV, onshore wind, and increasingly battery electric vehicles now become really very much part of a mature market. The other technologies that we look at or have looked at, digital twins, Ted talked about, are rapidly coming up that trajectory. Other areas like green hydrogen and electrolyzers, which we still think hold great promise, are a little bit further back. And are technologies that we continue to monitor. So just to finish with a quote from Mark Twain, who, as you may know, was once reading his own obituary in the newspaper, which was a bit surprising, and he said that rumours of his death had been, quote, greatly exaggerated. And we feel very much the same way about sustainability and impact investing. Some commentators are already writing obituaries for sustainability investing, but surveys routinely and consistently find undimmed demand for sustainability investing among savers, among pension beneficiaries, and particularly among young people and women. And we believe that the markets that we're invested in are overdue a recovery, and that moreover the fund is invested in companies that are trading at highly attractive valuations, as Ted has shown, and that possess high quality franchises. And we believe it's these companies that will that are ideally placed to convert that accelerating revenue growth into strong financial returns for you, our investors. So we are, as Ted has said, we are excited about the next few years and believe that the prospects of investing in sustainability have actually not looked this good for at least a decade. So thank you very much. I will now stop sharing, and I think we have some time for questions. So thank you.
Great. Thanks, gentlemen. A lot to unpack there. It does feel as though the green shoots are starting to peep through, so that is encouraging. We have a few questions already, and I've jotted down a few as well. But Seb, before we go on to questions, can you just clarify why the Scope 3 emissions of the fund are worse than the MSCI world?
Yes, the scope 3 emissions are the emissions related to the value chain. So Scope 1 is the direct burning of fossil fuels. Scope 2 is related to your electricity use in your own operations. Scope 3 is everything else. A lot of the companies that we invest in are companies that are making equipment that uses energy. It's energy efficient equipment, but it still uses energy. So an efficient air conditioning system, for example, that Trane might manufacture, still uses a lot of energy, but it uses less energy than its peers and its competing technologies, and that's why we own it. But we have quite a high concentration of those kinds of businesses in the portfolio. So relative to the MSCI world, we have a higher Scope 3 footprint. But it's so yeah, I hope that explains why that's the case.
That makes sense. So basically, generating a solution touches the challenge as well. Basically, we can't escape the challenge. Next question for you, Ted, which interestingly has been asked in a few different ways already, is the US is currently undertaking a massive economic experiment with its tariff program. It may work out, it may not, but all of a sudden, lots of fund managers are looking for, and in many cases, finding investments outside of the US. How are you thinking about geographic opportunities?
Yeah, so, I mean, thank you. It's a very good question. I think the sort of headline that we always come back with this is, so we try and deliver a really solid, authentic, sustainable impact experience, which is what our investors come to us for. And in doing so, we've always been thoughtful about what that opportunity set is and how we deliver that without sort of putting unnecessary kind of swerves onto it, thoughts that we might have which don't relate to sustainability. And as a consequence, we've been quite rigorous in having a geographic and regional allocation which matches a combination of our universe, which is not dissimilar to the world, but is a bit more overweight Europe, and the US. And actually, you've got to say over 20 years, in the early days, people said, oh, that's a lot of US exposure. And we were right, because you wanted to track the US, because that's where the market growth was coming. Obviously, we continue to think in those terms. We do have some latitude around that bandwidth. I think the US concentration has got to a very high level. So we are absolutely open to opportunities in other regions. But I think the fundamentals that we would somehow see this as a macro opportunity and pull a lever and then invest ex-US, I mean, sort of quite apart from the else, that would be taking a different factor than the sustainability alpha that we're looking for and applying that to the strategy. So we are pleased. We're certainly pleased, just to be explicit about it. Germany's plan, obviously on the defence side, is a separate thing, but as part of that, they're changing of their fiscal rules to allow more expansionary policy. That's good for Europe, and we may finally, in this dusty old corner of the world, get a little bit more growth at some point, and we're definitely watching that. And of course, the Japanese equities for a long time been very sort of cheap on a global basis, so we're aware of that as well. So we put these things into context, and we are aware of the opportunities. But I think the fundamentals of staying relatively cautious about macro will remain.
Understood. This next question is probably also for you, Ted, although Seb, you probably have something to contribute here as well. The AI players have driven a large portion of the growth in equity markets, but as you said, don't qualify for investment. But if AI is as impactful as most people think it's going to be, aren't those stocks likely to continue to run? And how do you think about hedging against that risk?
So AI will be very impactful in the sort of sense of impact that we use it in terms of helping to solve sustainability challenges. It's already very impactful in a sort of broader sense of making a huge difference to the way the world works. The sort of key points that we would make are, there's good data now out from the MSCI, which we didn't include in this pack, but we have, which shows when you've had periods of market concentration as high as the current period of market concentration, where you have whatever it is, 35% of the S&P 500, this very small number of stocks. A decade later, it's always half that, if not less. And the big cheerleader for this, NVIDIA, obviously it's not in our universe, so it's not been particularly relevant to us, but it does make a physical item, a semiconductor chip, and there are a lot of people who make semiconductor chips. Now, I'm not going to sit here and prognosticate that NVIDIA has peaked. People have been wrong about that a lot. But the direction of travel from not being in the sort of complex of the core of AI is interesting. And like everyone who's been in investment and watched the way bubbles work, you sort of look at this and think there's a lot there. There's a lot that has to happen. Now, the next generation for us, definitely making our companies more productive, solving sustainability challenges, improving their productivity. I think you're talking about better margins. That's what it sounds like, and better returns. So that should be very positive for us, as well as having the high levels of impact. And then more broadly, again, if you get that productivity boost across global markets, you get back to the point where potentially you get interest rates can be a bit softer, and that critical kind of investment confidence that people will go forward and say, we can invest in these solutions. And that should all combine, we think, to be the level of adoption of green technology that we would all like to see. In many ways, in the long period of low interest rates, which ran into 2020, the world should have gone further and faster in investing in green technologies. But maybe, we know there were challenges. That didn't happen for various reasons. There were challenges to it. So one of the key thought processes we have is it looks like AI could be one of the keys that unlocks that for us. So a lot there in my answer, but hopefully those who can watch it on replay can unpick the bits of that. I don't know, Seb, if you want to add as well.
No, that's fine. I think there are other questions. So.
Look, and I just would add to that if the benefits don't flow down the channel to the next level of industry, then you don't want to be holding the chip makers or the hyperscalers either, because they will be hopelessly overvalued.
Quite, absolutely. So, again, when you get to 35% of the S&P, it just gets very, very challenging to get higher than that. So let's see what happens.
Seb, I don't want to leave you out in the cold, so I'll ask you the next question. Your hype cycle included lab-grown meat. Is that still a possibility, or is the sort of farmers' lobby killed that off?
Yeah, no, it is. It is still there in the background. It had a brief. Listeners may remember there was a sort of a brief focus on alternative protein foods beyond meat a few years ago. That's definitely that hype cycle has definitely peaked and come down again. But the industry continues to make progress. I follow them quite closely. I think it's very interesting. You can buy lab-grown salmon now in the US. Actually, it's made in Texas, but you can't buy it in Texas because there the agricultural lobby has banned it. But you can buy it in other parts of the US. So progress continues to be made. The costs they are already coming down. It's still more expensive, but it will eventually be much cheaper than farmed salmon. And of course, the environmental impact is dramatically lower. So we think it's a very interesting technology, but it is absolutely in that the zone of disillusionment at the moment, but we'll come back because it's still making progress.
The irony that the product produced in Texas can't be consumed in Texas.
Yeah.
But if we sort of stay on the hype cycle, which of the technologies do you think has the most potential to move the dial from an environmental perspective and then by extension an investment perspective?
Yeah, well, I mean, really, it's anything to do with electrification. That's really the way that we're going to hit the lion's share of the carbon footprint. There was a front cover of the Economist a few years ago, which just said "electrify everything" as the kind of the moniker for the strategy around decarbonisation, and that is still true. 70% of all energy demand today could be met through electric technologies, and renewable energy is obviously critical to that. It's not an easy place to invest. It's become very commoditized, but there are definitely ancillary areas within the electrification complex that we absolutely do invest in, whether that's around the electrification of heating and cooling in buildings, the electrification of manufacturing. Ted talked about digital twin at Autodesk. A lot of that is around automating and electrifying processes within manufacturing, and of course building out the grid as well and making renewable energy accessible to people. That's another area that we invest in. Those are more the business models, and the ability of companies to control pricing in those areas is better than in renewables. So those are the areas that we have significant exposure to in the strategy.
Great, thank you. Ted, health has been a really tough place to invest. You've shown that it's been a huge drag on portfolio performance over the last year. Is there light at the end of the tunnel?
Well, I mean, surely, because obviously with the global population everywhere now aging, then that intensity of health expense is only going to increase, and the rewards to people who can help make more efficient ways of dealing with that will increase as well. And also there is a kind of a sentiment redistribution point in terms of performance of the market. I think a key thing that I always think about is, equity value creation. We had 4 decades where healthcare was definitely at the top, and equity value creation is very closely linked to pricing power and people earning supernormal returns. Now in healthcare, that's interesting because obviously the relation between a buyer and a supplier of healthcare is always deeply asymmetric. But I would argue now, if you look at the returns these companies are making, we've got back to a point where you can't really argue that healthcare is over-earning. And that, I think, is a condition precedent for an industry to start to improve again, particularly one like healthcare, which has got a big social contract. What I've just said, I appreciate, sounds very kind of highfalutin, but that's kind of the core of what's happening here. And then the other point to a bit more sort of straightforwardly is, again, AI's capacity potentially to change the number of molecules that are created, and then our ability to really start to deliver the most promising candidates through the process and get some of the big breakthroughs which have continually driven healthcare waves. So we had one running up to sort of 2010, then we had a bit of a patent cliff then to 10 to 15, and then we've had a little bit of a run up now and it's run off again. I think we see another of those periods coming out. So I think without there being like a silver bullet which returns it to some kind of the unusually strong run it had for a number of decades, I think it definitely looks more constructive as time goes on here.
Could you have described another example of capturing sort of the downstream benefits of the AI revolution, which I think is also relevant?
Yes, yes, absolutely. And to be clear, at this point, I want to sort of just, caution somewhat. We watch carefully, and of course, how it works and who captures the benefit is something to think about. I don't want to sort of present AI as kind of a sort of help all and save all, but it's the first place that you should be thinking about. I mean, in addition to which, this sustainability in the crosshairs, that will swing back. I mean, that's the route that we've tried not to spend too much time on, but like politics at the moment really is very, very extreme. And so just naturally that comes back and you get people making better decisions and it supports the industries that we want to invest in. So it's not just that this sort of AI Hail Mary is not a Hail Mary, but yes, that is definitely a key part of it.
Ted, can you just confirm that the understanding of that price to book graph is correct, that the stocks in your universe are on average 20% cheaper than the stocks in the same market on a price to book basis?
Okay, so good question. So there's a couple of points to make there. We've presented the portfolio chart rather than the universe chart. The universe chart is very similar. It's not the same, but it's just the message is the same. So in a way, take that. The whole sector has been challenged. Obviously, bits of the universe that we work in, the sort of domestically focused bits, have done slightly better. That's a small part. That's US sort of medical services, healthcare services, which are US only. So they've had a slightly different experience, but the picture is right. So that's the first thing to say. And what you said is not exactly right. We're not saying they're 20% cheaper if you just look at a multiples basis. And of course, just as a quick headline, like what is cheaper, that's absolutely a subjective conception. So we use DCF modeling as well. So there's these points. But trying to answer your point, what the chart actually shows is if one of our stocks, let's say, was trading at 16 times and its local market was at 14 times, 10 years ago, that's a premium of some maths I can't do because I show some numbers which are too complicated for me quickly. Anyway, some small number, 10%. And now that 10% has become minus 20%. So the rest of the market has continued on its view, and the market's view on our stocks has just really diminished. And we really like it because it's really very much like, okay, so equity investors like us around the world, when they're looking at their opportunity set, where are their eyes going to? And it just is striking that nobody is interested. Very few people are interested in sustainability. And we're seeing other, I know it's a long answer, but we're seeing other signs as well now. As you think about the way stocks behave when value investors are starting to get interested, we're starting to see that. And that for me is a very bullish sign.
So basically getting to the point that regardless of sort of ethical criteria, the stocks are so cheap, everybody should be looking at them. We are almost at the end of time, so quick question for you, Seb, and try and keep your answer short. What points of optimism do you see around the world for those who remain committed to sustainability?
I mean, there is still, plentiful grounds for optimism. In fact, there was a really interesting report that some of you may have woken up to this morning in Australia that came out yesterday from the UN. Antonio Guterres talking about fossil fuels at the end of the road, quote, 92.5% of all new electricity capacity additions globally last year were renewables. That figure was 94% in America. So it's overwhelmingly the power generation additional capacity is now overwhelmingly renewables. We're seeing it in battery electric vehicles as well. 45% of all 2 and 3 wheelers globally are now electric. 43% of buses globally are electric. In passenger vehicles, which we tend to focus on because those are the ones we use, in 2018, only 2% of passenger vehicles were electric. By 2022, it was 14%. In 2025, it's expected to be 26%. So these changes are happening, but the narrative that we hear in the media and certainly in investment markets, as Ted has just said, is overwhelmingly negative. But actually, these changes are happening. They need to happen more quickly, but there's no question that they're happening. And so I certainly look at those underlying numbers, the data. If you look at the data, it does give you cause for optimism.
Great, thank you. We are out of time, but those definitely are a few positive notes to end on. We haven't got through all the questions, so apologies. We will respond to those that we didn't answer directly. Thank you very much for dialing in. If you do have any other questions, please get in touch with us directly. We always love to hear from you. We love to engage. And thanks for your continued support.